Sticking with the region, the world's biggest election is underway in India, where Prime Minister Narendra Modi is up for re-election. Nearly 1 billion people will go to the polls over the next 6 weeks. Now, India's growth story hinges on continued economic reforms. Experts say Modi's promise of strong economic growth at a time when China's story continues to unravel has, in a way, shielded the Indian leader from criticism of his handling of human rights issues and the government's continued purchase of Russian and Iranian oil. Investors, meantime, continue to pour in. The MSCI India ETF up nearly 30% over the past year versus the emerging markets ETF up just about 1%. There's double lines. Jeffrey Gunlock, who in February said India is the #1 recommendation for his clients in 2024. Let's discuss this and more with Jitania Kandhari, Portfolio Manager, Global Emerging Markets at Morgan Stanley Investment Management, with assets under management of $1.5 trillion. Jitania, it's nice to have you on. Clearly, a lot of excitement around this market, but how could this election present some level of risk for your bullish stance here?
Yeah, I think there'll be three things that I'm looking forward to with the government and if the consensus holds on the BJP victory. One is, fiscal consolidation path, which has been very interesting and key, which helps the government to spend on infrastructure, therefore that spending to remain, and just prioritizing CapEx. So I think this should be what we could expect from the policy side. The risks, again, can be an oil price hike because India's current account, fiscal accounts, get impacted negatively. Anything above $9,500 in oil prices could impact the macro stability because at this point, inflation's under control. Current account deficits are much, much lower than the past. The fiscal trajectory is on a good trend, and even real rates are pretty decent at 2% positive real rates. So the stable macro, along with consistent reforms, is needed. Anything that goes against some of the macro indicators related to the oil price can be a negative at the margin.
Well, if you look at how investors are allocating their money, U.S. versus international, it still seems like U.S. fund managers are a little reluctant to put more money into the emerging world, even though you have these sort of secular growth stories, whether it's India, Taiwan, Vietnam. Why do you think that is, or is that going to change soon?
Yeah, I think that, the U.S. market and U.S. exceptionalism has led to flows. There's a lot of the home bias. So there's also academic work done on this. And unfortunately, when emerging markets actually start performing, that's when money really starts coming in, even in the past, in the 2000 run. I do think that, they, as I mentioned, their fiscal their debt situation, again, it's a heterogeneous asset class, so there are differences and different idiosyncratic stories. But overall, the growth differentials and the interest rate differentials, which have favored the U.S. so far, which have helped the U.S. equities and kept, the emerging market as an asset class lagging, I think that that's kind of peaking because a lot of the markets are beginning to see the growth upside because they're cutting rates. Also, interest rate differentials with U.S. rates where they are, the differential with the rest of the emerging markets seem to be at peak. So I think that there will be some interest as the performance improves over time, especially at this point. I feel like there's lots of opportunity with the geopolitical drawdown that's happening globally.